All right, Counter Range Theory Trader back with you with another video showing you how you can retire early trading the 15-minute chart. So we're sticking with the counter range theory and using this one chart. All we need is just one chart. You're not flipping back and forth between time frames. And this right here will definitely help a lot of people. So let's not waste time and get right into it. What this video is going to cover is the trading plan that we need to follow, how to set up our chart, how to find the money candle, I'm going to say what that is, and your trading zones where you should be trading, how to manage risk, and some real chart examples. So here is the trading plan, verbatim, very simple, easiest trading plan you're ever going to see. And of course, we're using the candle range theory. If you do not know what the candle range theory is, you're going to want to pause this video, check the links in the description. You'll see that in that description. You really don't have to have a deep understanding of it, but this plan does follow that. So here we go. When you come to it, ideally during London session or US session, but it could be any time of day. All right, so there you go. All right, so ideally what you're going to want to look for is this. The first question that you need to ask yourself: is price at or above the prior day high or the prior day low? Okay, if price is consolidating inside the prior day's range of the high and the low, there is no trade there. Okay, it's just consolidating. We ignore it. If we do see that the price, when you're looking at the chart right now, is above the high or below the low, that's what we're interested in. We continue. Next, we're looking for a money candle. Okay, and I'm going to explain that in a few minutes, so just be patient. Okay, but is there a money candle identifying the current high of day or low of day? If yes, you're going to want to mark the low of that candle if you're trying to go short, or mark the high of that 15-minute candle when you're going long. Again, I'll show you this, so just be patient. Next, has price broken the low or high of that money candle that you just marked? If yes, you could enter, or you can possibly wait for it to retrace to get a better entry. But if the low or high of that money candle that you isolated has not been broken, there is no trade there. Okay, there's no trade there. So once you enter the trade, you're going to set your stop loss above the high of day, below the low of day, or a different level. I'll talk about it a little bit later. And your take profit can be the daily open or at 50 pips. So whichever you want to do. So let's get into this and let's show you now how to set up our charts on TradingView. All right, so we're going to shoot over to TradingView. This is the indicator that you're going to need on the chart. Now, if you're wondering why my candles are black, I just like them this way. So that's it. Okay, so but you're going to want to go to indicators and you're going to find the indicator called Mark Levels, okay, by Mark Tools. Okay, and then some lines should appear on your chart. They're going to be light gray. This is the levels that we'll need. So this is what to check. This is your set. These are the settings that you're going to want to use. Let's see. You don't need the monthly levels. You don't even need the weekly levels. We're focusing on the day. Okay. All we need is, again, we just uncheck all that. We don't care about any of that. We're focusing on the day. We need the day, the daily open, swept you can leave checked. You need to know the previous day's levels and the current day's levels. So you're going to check that one. I also like to make the appearance of the indicator black. So let me find that. I think that's right here under style. Let me make sure the opacity is like 100%. I think that should darken it up. Yeah, it does. All right. And that's it. All right. So here we go. So you see right here, you have, let's go through this to see what you should see. When you're done with your chart, you should see PDH, which stands for prior day high, HOD, which stands for high of day, DO, which stands for daily open, PDL, which stands for prior day low, and LOD, that stands for the current low of day. That's it. So all you need are those elements: PDH, HOD, DO for daily open, prior day low, prior day high. Okay, that's it. And then current low of day, current high of day. And then just save this template. All right, so and then you just go there, click save indicator template, and save it. All right, so you just have it there. So let's go back to our presentation. So how do you find the money candle and the trading zone? Okay, how do you find that? So here it is. Okay, the money candle is going to be marked by the current high of day or low of day. So Mark Levels is automatically going to mark that for us. Isn't that wonderful? Okay, so the red arrow right here, and you see right here where it says HOD, that right there is the money candle. So you do not have to, oh, is this the money candle? I don't know, is this one, is that qualified? No. All you need to do is say, okay, what candle on the 15-minute chart has the HOD by it if you're going short, for example? That's your money candle. All right. Now, will the HOD change? Yes, it will, because this is a what's called a repainting indicator. Because sometimes lows get taken out. This used to be the low. This used to be the low. Now this is the low. All right. So it will change, but there's something that we use to be sure to avoid losers, and I'm going to show you how to not get stopped out in a few seconds here. Okay, so that's your money candle, though. That's where you find that. Now, what is your trading range? Remember that. Remember the sequence of events. Once you get your money candle, what you're looking for is price to close below the money candle. And once it does that, then that's your signal to, okay, now you can start going short. Your trading range is going to be between the close of the money candle and the high of day in this example. All right. So just to go back to this live chart here, this is a live chart that we're looking at right now. Let's say I was trying to go long on this chart here, which I'm not because it's 112 on a Friday. So I think the market's done just about all it's going to do. This right here is my money candle. See where it says low of day? So I placed just a little line there. You can do your trend line. You can do whatever. And I would say that would be my money candle break right here. So what I need to do is see price close above this candle's high, which it has actually done right here. All right. And then from between about here to all the way to the low of day, all that's my trading zone. So theoretically, I could get into this, but I'm not going to hold anything over the weekend. I'm not interested in that. All right. But that pretty much is the trading zone right there. It is, let me see how big it is. This is about a 23 pip zone. All right. Obviously, your stop loss will go outside of the range because you believe this low of day is going to hold if you're doing it like that. All right. So the ideal trading zone again is between the break of the money candle and the high of the day. But I showed you a long example right here with the low of the day right there. Okay. So once again, money candle is the low of the day. You do not have to think about this. The mark levels is going to show you where it is. And then all you have to do is just wait for a break of this candle. Breaks here, you're cleared to trade. But again, because it's a Friday afternoon, not ideal for trading, all right? Because things are pretty much going to consolidate into the weekend more or less, all right? So let's keep going. And I'm sorry, for low day, this is a high of the day example, but lower day is just the same in reverse as I just showed you. Okay, so let's talk about our risk management now. So once you enter a trade, you have two options for a stop loss. Your first option is above the high of day in this example. So let's say you enter the trade right around here because candle range did break. Your first option is above the high of the day. What's the benefit of that? You're not going to be stopped out as much, but your position size may be smaller. So instead of taking, say, like a half a standard, you can only take like a 0.2 because the stop loss is going to be bigger. It's going to be like 30 pips instead of like, say, 15 or 25. Now, your next option, though, is going to be above, in this case, because you're going short, a recent retrace. So you see here where it says SL option 2. See how price retraced just a little bit and then started going down? You could put a stop loss right there. And the benefit of that is that that's going to allow you to have a bigger position size because your stop loss is going to be smaller. But you could get stopped out more often because it is possible that price could go back up to near the money candle and then reverse. All right. But either way, you want to keep your risk fixed. Going into day, you need to know how much I'm willing to lose. You don't go into each day thinking how much you want to make. You're going to think about, okay, I'm willing to lose $100 today, and that's it. Or I'm willing to lose $50. That right there, coupled with your stop loss, is going to determine how big of a position size you should be taking. Now, where should you put your take profit? Very simple. Option one, just do a fixed 50 pips. All right. The benefit of that, you're probably going to win more consistently, but the downside is you're going to cap your profits. If you take 50 pips, but then the pair goes on to drop by 200 pips, and I've seen that happen, it is possible, you got to be content with that. Now, your option two, though, is that you can set your take profit at the daily open, okay, which sometimes will be farther down than 50 pips. Sometimes they'll be one and the same, but daily open also is an option for you. The benefit to that, you're going to have bigger profits. Okay. But the downside is you'll have to wait longer and there's no guarantee it's going to hit the daily open. It might stall out right before it gets to it. Like in this example right here, 50 pips is just right here. The daily open is all the way down here. So you can either get 50 pips or you could possibly 102 pips. All right. But which one is more likely? Which one is going to get hit first if price does continue downward? The 50, obviously. So imagine getting these consistently, or you can take the 102 pips, but you won't get that hit as often. So these are the scenarios with using this was using the New Zealand yen. This was this example here. This is the New Zealand yen pair. Now these are the possible outcomes. Let's say your risk is $100. Option one, if you put your stop loss above the HOD, the HOD for this example right here, if you would have got in right when the price broke, your stop loss would have been about 30 pips, okay, going short. And if you set your 50 pip take profit, your lot size would have been about a 0.47, so almost 100 standards. Again, your risk is still fixed at $100, but if it would have hit, you would have made $158. Okay, so you risk 100 to make 158. Option two, let's say you want to go for the retrace. So this option right here, remember you do that, but your chances of getting stopped out, they go up because price could keep retracing and then come down. But what you'd be looking at if it worked out, your stop loss is much smaller. You got 15 pips. Your daily open is 102 pips, so you can risk $100, but you can make $653, right? But remember, this is higher risk because 15 pips is as much as 30. All right. Option three, you put your stop loss above the high day and then take profit at the daily open. Your lot size, of course, would be the same as this option over here, but you would risk 100 to make $653. All right, so of course you'd have to wait longer for that, but that is possible. And then option four, you can set your stop loss at the recent retrace and then just do 50 pip take profit, and then same numbers. In essence, you're still risking $100 to get a possible $158 gain. So it's more or less you're changing where you're putting your stop loss and your take profit. But either way, the risk though, the only thing that's still fixed though is the $100 loss. That's the one constant that you'll see in all of these levels here. All right, but that's just a possible outcome if you're risking $100. That is amendable, but that's up to you. So let's take a look at some chart examples here. Here are some shorts. So let's see. Step one, remember we look to see. You come to the chart. Is price above the high of day, the prior high of day? Yes, it is up here. Okay, so that's just where it is. Where is the money candle? We see right here. Okay, where my cursor is, high of day. That's a possible money candle. So you just mark the low. That's all you got to do. You wait for price to break. It has done that on the very next candle. So now it's like, okay, we're clear to trade. Now and then it does retrace a little bit. It will do that. Don't let that freak you out because if you notice the high of day is holding. You should not see the high of day getting poked at or broken. If the high of day gets broken, you're going to get stopped out. Okay. But the retrace gave good opportunities at 7:30 a.m., 9 a.m., and 9:30. And then price did eventually go down to the daily open. And that would have been an 85 pip gain down to the bottom. Okay. But once again, very simple. It's price above the high of day. Okay. Next, I need to find my money candle. Next, I need a break of the money candle low when I'm going short. And then I just expect a straight drop. With some retraces, that's fine. But at the end of the day, it should not break the money candle high. All right. Should not break the money candle high. Next, once again, we come to the chart. Is price above the prior day high or at least right at it? Yes, it is right up here. All right. Okay, next, where's our money candle? To find your money candle, you're looking for the HOD, high of day, when we're going short. Okay, next, good. I marked the low of that candle. Where is it? When is it going to break? Not a wick. Remember, it has to close below. Don't drop down to this is 15 minutes only. Do not drop down to a 1 minute chart or a 5 minute chart trying to find a tighter entry. Forget it. Stick with the 15 minute. All right. If you change your time frame, your results are on you. But if you stick to 15 minutes, you're good because your money candle is 15 minutes. So your break needs to be on 15 minutes. Don't switch it up. This is the only chart you need for this example. All right. So we take that entry there. Straight drop. This was 70 pips. All right. It didn't hit the daily open here, but I mean 70 pips, you can live with that. All right. 30 pip stop loss, 70 pip take profit. That's at least a 1 to 2. So you can risk 100 and make a little over 200 on this little bitty price action right here. Very simple. All right. Let's take a look at some long examples now. So remember, step one, is price below the prior day low? Yes, it is. Right here. Okay. Next, I'm looking for the money candle. Where is the candle that's showing that LOD? Here it is right here. So I marked the top of it because I want to go long. Then it does go long right here, closes above it at 10 a.m. The entry did go up. This was good for about 35 pips. It was close to the daily open. And sometimes the daily open won't be 50 pips away. This is a lower ADR pair. This is a Canadian dollar, Australian Canadian. Some of those pairs have a lower average daily range. Okay, just is what it is. But I chose these just to show you the example of the pattern. All right. So once again, here's another example on Euro Canadian. Step one is price below or at the prior day low. Yes, it is. Down here. Next, where's my money candle? Where's that low of day? It's right here. Okay. Next, I need a break of it. Great. It broke right here at 9:45. I enter. Okay, and then this would have been a 20 pip stop loss, but an 83 pip rise. That's about 1 to 4, risking 20 pips to get 80 pips. It shot past the daily open and kept right on going. That can happen too. All right. So you would have been good with either 50 pips or even beyond daily open. You'll see that too sometimes. Just depends. All right. So let's keep going. Now there are times when you'll have a false money candle break, and that will happen because let's go through our steps. Okay, we got the prior day low right here. Price is below it. We love to see it when we're trying to go long. This right here was the first low of day. All right, this candle right here, it did break above it. As you see here, price started going up. I don't know if this was news or what, but it did tank after that. This would have been a stop out, and that's what we're talking about, controlling risk. All right, so you control the risk, you take the stop out, and then I would give it one more shot. I would not take a trade multiple times trying to recoup losses. Don't chase it. I would only give it one more chance to give another money candle, a new low of day, and then a break above it, and then try to get profit. I wouldn't take the same pair more than twice in a day, though. All right. So the real money candle, the lower day came in right here at 9:45. We see the break right here. Okay, and then price just did a straight rise. Sometimes you'll get a straight rise, it won't retrace at all. So I don't have a problem getting in on the first break. If the break isn't that big, or if it's not like huge and the stop loss is fairly tight, I'll get in. I don't mind that at all. And if it's tight enough, sometimes you can give the low of day a little wiggle room and your stop loss a little room to breathe. But ideally, this is what you like to see, a straight rise. But it could go either way. It could do this, could do this, could do this. And even just to use this example over here, you see how price chops around the break level here? You'll see that too. You'll see all of that. So just be prepared for that. All right. So, but don't let stop outs freak you out. Okay. So when you backtest for yourself, which you don't have to spend all day doing, I'd only recommend about a month or so. You don't have to backtest for years. You're only looking for the same pattern. Train your eyes to see this though. So you can use the daily chart for your own backtesting example. For example, here is a pound Australian. All you're looking for on the daily chart, and again, you're not trading the daily chart. This is just to go, you want to go back and see, okay, let me see if I can find money candles, breaks of those money candles, and where profit hit at, and what time of day that was. And take a screenshot or two, and that's fine. And remember that you only want to take screenshots or take note of when you want to trade. Will you see this happen in Asia in terms of the setup? Yes. But if you're not habitually trading the Asian session, don't worry about that. If you only want to trade London session, you should only be focusing on trades that take place in London. If you only want to trade US from like 9:30 to really 4 or so, do focus on that setup. Okay, don't worry about Asia, don't worry about London. Okay, me, I trade London and US, but I don't really trade Asia. All right, I don't really do that. All right, so just focus on that. So this is the daily chart right here. Where you see here, this is the prior day high. You just put a little red line here, put the candle range high right here, because what you're looking for is a chart that a candle that goes above and closes back inside. This is how the candle looks when the day is over. Okay, this is your trading day right here. So then you want to see, okay, well, how does that look on the 15-minute chart? And you just drop down. This, okay, this is your daily open. This right here is this daily candle. Price opened, went all the way up here, and closed back down. So where's our entry? Price opened, went all the way up here, closed back down. Daily open, okay? So how do we trade that? First off, price has to be above, okay, above the candle range, above the prior day high. It is up here. The best entry would have been here at about 1:30 p.m. That's when our last money candle arrived. Now, were there some fake outs? Yes. Okay. So let's talk about that real quick. You did have a money candle, say, I'll just use these for example, right here. See this, and I'll put an arrow on it. But this might have been during Asia. I don't have the sessions isolated, so we'll use this one here. Because again, I don't recommend trading it more than twice. So let's say you have a candle. No, we don't want that. There we go. Let's say we have a fake money candle here where we think, okay, this is the high of day and it has broken right there. Okay, closed back inside. Wiggled around a little bit and then shot right back up. Okay, this would have been a stop out if you thought this was the real high of day. So when this happens, you just give, and this might have been like London, I think. But again, I don't have the times on here, so I really don't know. You wait for the next one. You give it 2 tries and that's it. All right. And look at this. This was worth it because let's say you only risk 30 pips on this one, right? Or so. 30, but then price, when the real money candle hits and you take it, this was an 85 pip drop. So you lose 30, but you make 83. So you end the day net positive with a net 50 pips. Okay, just to round it. Because this entry here would have been a 27 pip stop loss and an 83 pip take profit. Take profit down to the daily open. Done deal. All right. But once again, don't let fake money candles freak you out because the high of day may not always hold. You will see this. But this was just to fool people into thinking price was going to continue long. And then price did eventually close back inside the range. This was at 1:30 p.m. though. This is USA session. All right. But this is just for a day trade only. Simple trade. So this is what you're looking for on the daily chart. As you go through the daily chart, and I'll do it real quick live just so you know. Let's go to the daily. And I'll go to another pair. Let's do EuroCAD. What am I looking for? A wick that pokes above the day and then closes back inside of it. Let me do a higher ATR pair though. Let's try. Actually, let me see if I can find a long example. The only thing is I'm not sure if I got to make sure my 15-minute, it'll allow me to see the 15-minute. Let's try Euro. Everything wants to go up really sharply. Looking for a good one real quick. Okay, here we go. This isn't a very big one, but it'll work. Okay, so we have a daily range right here. And I notice this wick, this was Wednesday, March the 5th. And I noticed that Thursday poked below it and closed inside of it. So I mark it for a candle range low and see how the wick, let's zoom in. Let's make this huge so you can see it. This is for your example. This is for you building a little quick library. Okay, see how this daily candle wicked below it and then closed all the way up here. So now we see, okay, where's my entry at? So this is March the 6th. So I'll do the replay. And I think if I click on that day there, no, let me do one more. Okay, and then I drop down to the 15-minute. Okay, so and then I'm trying to find, okay, where is the money candle at? It's right here. Okay, see, because the money candle, I love the fact that it's already marked for you. Your first step, make sure it's below prior day low. Yep, money candle right there. Where's the break of the money candle? Because this is what I want to see right here. The break back inside was right here. So that could have been, well, I'll use the trend line. The break was right there. You could use that for a possible entry. And win or lose, I mean, that's all you're really looking for right there. Okay, so and then note the time. So this was at 11:30, 11:45. Actually, 11:45. That would have been the entry. 11:45 a.m. Eastern Standard Time. Okay, and then if you just let it play out, see what happens. Does it go up or down? And ideally, if you want to shoot, one last secret I'll tell you, Sometimes when the candle range, you can see it go. See how that? One last take profit. I'll do this since you stuck around so long. If you want to shoot for the prior day high, you can do that too. Because remember, we're still candle range theory traders. This trade would have been good for 124 pips. Okay, that's more so a swing trade than a day trade, but you see right there the power of this. But the 15-minute chart is all you need. All right, showing you a very simple plan. It was below the prior day low, same steps. Money candle breaks. You got 3 options. Okay, one bonus option for you for sticking with me so long: 50 pips, daily open, or the prior day high or prior day low. That's it. Okay, so remember, this method is the best because it's low risk, high reward. You only have to focus on the prior day high and low in terms of where price is. If the price isn't above it or below it, there's no trade. Your candle range is already built in, so you don't have to worry about putting a whole bunch of lines on your chart. You only have to worry about one time frame. And if price hasn't closed inside the range by 4:55 p.m. or near the close of the day, there's no trade. The trade is nix. Tomorrow makes a new day. So remember, your money candle high or low must hold. Okay, just to use this example right here, this low for the money candle, it cannot be breached. That is your like main support, for lack of a better term. Okay, the trading range is best between the money candle and the money candle break. Okay, and I think I've showed you that, so you should know what I'm talking about when I say that. Remember that your price won't always retrace. You got to get over that. If price drops fast past the money candle, in essence, what I'm saying is that if the money candle closes like all the way, like let's say it closes like all the way up here. Let's say it broke and it went like 20 pips past. Like here's the money candle, and then the next candle closed all the way up here like 50 pips. There's no trade there. Either it's going to come back or it's just going to keep rising. But we don't like to see big closes way beyond the money candle. If that happens, forget about it. Wait for it to retrace, or there's just no trade. You find another one. These trades are a dime a dozen. Price must close inside the day's range to be valid if you want to hold it overnight. What do I mean by that? Same example right here. Okay, price has to close inside of the prior day high, prior day low. It should not come back outside the range. It has to be back inside of it. So this green line right here, price needs to close and stay inside of it for the trade to be held overnight if you want to do it that way. Okay, that's what I mean when I say that. It should not break back outside the range. If you get stopped out, you can follow the pair for one more try or just find another opportunity. Okay, because there's always the possibility when you do this, you could be trading against the trend. So imagine, go back to the daily range here. Okay, see here, obviously this is in an uptrend. So imagine you keep trying to short this and price is steadily rising, rising, rising. Okay, that's why you control risk, manage risk. If you're in a clear uptrend, you don't want to try to be going short. Okay, because this was in an uptrend for since February and it's March. So over a month, steady uptrend. So if anything, you're looking for stuff like this right here. Here's another real good example. So again, if you're still with me, I just appreciate your time. So I want to give you as much value as possible. So I just happened to come across this. Let me get my tool. I'll just use this. See this right there? That right there. That right there is what you're looking for. And that skyrocketed beyond the prior day high. So let's take a look at this one real quick, and then I'll let you guys go. This was on Friday, February 28th. This was on Monday. Not ideal for holding over the weekend, but things happen. So repay real quick just so you guys get it. Drop down to the 15-minute. Okay, once again, price, is it below the prior day low? Remember our steps. Yes. Okay, next, where's our money candle? This is a big money candle, but that's fine. Right there. That candle makes the low of the day. Now, don't like to necessarily see them that big. However, the premise is still the same. This does create a sizable stop loss there because that was about 83 pips. Sticking purely to the rules, you would have had to see a close right here. That's technically our money candle break. So our entry zone really could be anywhere after it breaks. It doesn't break until about, what was this, 3:30, 3:45 p.m. Eastern Standard Time. So right at the daily open. And the trading range, this money candle gave us a fairly sizable trading range. But as you can see, if you'd have entered here, after the break, and just let it play out. This is this Monday. Yeah, that's Sunday, Monday. Of course, money candle low does hold, and we already know what's going to happen. We have the benefit of hindsight. The price just skyrocketed up. Okay, so for something like this, you still got that close above it. That's the money candle break, and the low of day does have to hold. So worst case scenario, that would have been a stop loss of about 30 pips or so. So this one right here, bit of an anomaly, but at the same time, the upside, once it took off, you're talking about 118 pips. I think it went for more because it kept going. So let me go back to the daily and see how far it really went. And I'm not trying to advocate swing trading here. I'm just trying to show you. Let me see here. Let me get out of this. You'll see that entry right here on Friday. Remember, small candles lead to big candles. Look at all that. Price didn't really start to come back until really today, which is Friday, March 14th. So that right here from the zenith, that was 500 pips. Okay, over 13 days. Okay, but again, I'm not advocating holding a trade for 13 days. I'm not saying that, but I'm saying that this premise, if you catch a trend and you want to try to mix some elements of swing trading, hey, feel free. This is just one example, but you could have had a great example here to count on this small candle leading to a big candle is the point. All right, so remember, if you get stopped out, find another pair, find another opportunity, or you can just follow it for one more try. And always manage risk, manage risk, manage risk. Okay, your stop loss should determine your lot size, like I showed you in these examples right here. Okay, stop loss 30 pips. Your risk is $100, and you make that work to figure out, okay, how much big does my lot size need to be in order to have 30 pips as a stop loss and still keep my risk fixed at a set of $100, just for that example. Okay, so I appreciate you watching. Please subscribe, and your trading will never be the same. I thank you for your time and attention. I hope you got some value from the video. Like it, leave a comment, and again, I appreciate you. Have a great rest of your day.